from delivering newspapers in Omaha to controlling one of the world's most valuable holding companies. Today, Berkshire Hathaway owns railroads, insurers, utilities, manufacturers, and significant stakes in global giants. But the path wasn't what anyone expected. There's one decision Warren Buffett made that changed everything. Most people never see it coming. Warren Edward Buffett was born on August 30, 1930, in Omaha, Nebraska. His father, Howard Buffett, worked as a stockbroker and later served as a U.S. congressman. According to biographies and public interviews collected by reputable outlets, his childhood was marked by curiosity about numbers, enterprise, and markets. He read financial pages early. He experimented with small businesses. He sold chewing gum and Coca-Cola, door to door. He placed pinball machines in barber shops with a friend and learned the fundamentals of buying assets that threw off cash. Formal education took him from the Midwest to the East Coast and back. He attended the Wharton School at the University of Pennsylvania before completing his undergraduate degree at the University of Nebraska. The turning point came at Columbia Business School under Benjamin Graham, co-author of Security Analysis and author of The Intelligent Investor. According to Buffett's public statements and Berkshire Hathaway's shareholder letters, Graham's concept of intrinsic value and the margin of safety became foundational. The idea was straightforward. Buy securities for less than what a careful appraisal of their underlying business would suggest they are worth. After Columbia, Buffett briefly worked at his father's brokerage and then at Graham Newman Corporation in New York in 1954, gaining direct exposure to Graham's methods. When Graham retired in 1956, Buffett returned to Omaha and formed Buffett Partnership, Limited with local limited partners. The philosophy was crisp and documented in letters to partners: seek mispriced D securities, including generals, undervalued stocks, workouts, event-driven situations, and controls, where a controlling stake could unlock value through changes in operations or capital allocation. The record of those partnerships would become part of investing law, but at the time it was a disciplined, concentrated approach run from Omaha. Early case studies established the pattern. The Sanborn Map Company owned a marketable securities portfolio that the market was valuing below net asset value. Dempster Mill, a struggling windmill manufacturer, required operational fixes and capital redeployment. According to archival letters and reputable biographies, these investments were hands-on and analytical. They also foreshadowed a trait that would define the empire: a willingness to learn from mistakes and to pivot when a better framework became clear. The problem Buffett observed was bigger than a mispriced D stock. It was structural. Public markets often misallocate attention and capital. Good businesses can trade for less than they're worth. Bad businesses can command high prices. The opportunity wasn't merely to pick stocks. It was to build a mechanism that could continuously acquire durable cash flows and allocate capital to the best use, over years, not quarters. The pivotal moment arrived in the early 1960s with an ailing New England textile mill, Berkshire Hathaway. The textile business faced relentless competition and low returns. The stock, however, traded below working capital. Buffett began buying shares in 1962, gained control in 1965, and installed a disciplined capital allocation approach. He later called the textile purchase a mistake, an important lesson recorded in Berkshire's shareholder letters: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The mill itself wasn't the prize. The corporate shell became the vehicle. The insight that would power the next 6 decades predated the Berkshire takeover. In 1951, as a young investor, Buffett visited government employees' insurance company, Geico, to learn about the insurance business firsthand. Insurance economics stood out: collect premiums today, pay claims later, and invest the float, the money held between receipt and payout. If underwriting breaks even or better, float becomes low-cost or even cost-free capital for investment. According to Berkshire's annual reports, that insight became the foundation for Berkshire's model: own insurers that underwrite conservatively, grow float over time, and deploy that capital into high-quality businesses. Initial skepticism was understandable. A value investor controlling a failing textile mill in the 1960s did not look like the blueprint for one of the world's most successful holding companies. But Berkshire was never meant to be a textile story. It was the container for a compounding machine. But Warren Buffett was about to make a move that would change everything. Because once a disciplined allocator controls a steady source of investable funds, the game becomes fundamentally different. The breakthrough was structural, then strategic. Berkshire Hathaway pivoted from a manufacturer to a fortress for float and a home for wonderful businesses. In 1967, Berkshire acquired National Indemnity and National Fire and Marine from Jack Ringwalt for approximately $8.6 million, according to Berkshire's historical disclosures. Insurance float, premiums held before claims are paid, moved onto Berkshire's balance sheet. Over subsequent decades, Berkshire's float grew from millions to well over $100 billion, as reported in annual letters. The firm underwrote conservatively to avoid catastrophic losses, tolerated low growth when pricing was inadequate, and emphasized financial strength. This created a structural advantage: investing with a multi-decade horizon using low-cost funds. From there, a series of foundational purchases taught refined lessons. In 1972, Berkshire and an affiliate purchased See's Candy Shops for $25 million, a price that felt full on book value but was modest relative to the brand's pricing power and customer loyalty. According to Buffett's letters, See's delivered exceptional returns on tangible capital. The lesson: intangible assets, brand, reputation, distribution, can create economic moats that produce cash far in excess of tangible book value. This insight, reinforced by Charlie Munger's influence, shifted the approach from cigar butts to high-quality franchises. In 1973, Berkshire invested in the Washington Post Company at a time when the market valued it below conservative estimates of its assets. That position appreciated substantially over the years, as later noted in Berkshire letters and reported by the Post itself. Geico re-entered the picture in a critical way. After facing difficulties in the mid-1970s, GEICO's restructuring and low-cost model attracted Berkshire's capital. Berkshire bought a significant stake in 1976 and ultimately acquired the remainder in 1996, in a transaction valuing the company in the billions of dollars, as reported in company statements and reputable financial press. Geico became a pillar of Berkshire's insurance operations, supplying both float and underwriting profits. The Coca-Cola investment, initiated in 1988-1989, crystallized the "wonderful business" doctrine. According to Berkshire's 1989 shareholder letter, Berkshire invested roughly $1.3 billion to acquire a significant stake in Coca-Cola. The rationale was enduring demand, global distribution, and brand strength that allowed pricing power. Dividends and capital appreciation over decades validated the thesis. American Express, Gillette, later part of Procter & Gamble, and Wells Fargo, Names that appeared in Berkshire's portfolio in past decades echoed the same pattern: durable economics, strong moats, and managements aligned with shareholders. Privately held operating businesses expanded the foundation. Berkshire bought Nebraska Furniture Mart from Rose Blumkin in the 1980s. Mrs. B had built the business from scratch, and Berkshire provided permanent capital and autonomy. Borsheim's Jewelry, Scott Fetzer, acquired in 1986, and later Dairy Queen, Fruit of the Loom, Benjamin Moore, Johns Manville, and many others joined Berkshire's roster. The model was decentralized: acquire great managers and leave them to run their businesses with minimal interference. Headquarters remained lean. Culture emphasized trust, autonomy, and rigorous capital allocation. Two reinforcing mechanisms kept the system compounding. First, communication. Berkshire's annual letters, widely cited by investors and business schools, codified the principles: intrinsic value over market price, owner's earnings over accounting optics, conservative financing, and the power of time. Second, discipline. Berkshire often held large cash balances when prices for equities or businesses did not meet internal standards. When markets repriced risk, Berkshire moved decisively. The pattern was systematic. Build a durable cash engine in insurance. Add exceptional operating companies. Take minority stakes in world-class public businesses. Underwrite risk conservatively. Hold for very long periods. Let compounding and retained earnings do the heavy lifting. But success was about to attract unwanted attention, because scale invites scrutiny, markets shift, and even the best systems face real-world tests. Empires are tested in crisis. Berkshire's journey includes moments where reputation, capital, and judgment were on the line. In 1991, Salomon Inc. faced a scandal after a trader violated U.S. Treasury auction rules. The company risked being barred from bidding in Treasury auctions, a potentially fatal blow. Berkshire was a large shareholder. Warren Buffett was named interim chairman. He worked with regulators, testified publicly, and imposed strict compliance measures. According to the New York Times and public records, Salomon avoided a permanent ban and survived. The episode reinforced a Buffett axiom quoted widely: lose money, and understanding may follow; lose a shred of reputation, and consequences will be severe. Culture was not a soft concept. It was a risk control. The late 1990s introduced a different challenge: irrelevance, at least in market narratives. The dot-com boom vaulted profitless companies to high valuations. Berkshire, focused on cash flows and durable moats, refused to participate. Relative performance suffered. Commentators questioned whether value investing was obsolete. Then the bubble burst. Berkshire's approach, unchanged, looked prescient. But the years in between demanded an uncommon temperament, willingness to be out of step when crowds surge. The insurance complex faced a stern test after Berkshire acquired General Re in 1998. The business came with derivative exposures and underwriting issues that needed cleanup. According to Berkshire's annual reports, risk was reduced, legacy positions were unwound, and underwriting discipline was reimposed. Then came the September 11, 2001 attacks, producing large losses for insurers and reinsurers. Berkshire's financial strength allowed it to absorb shocks and continue writing business when others pulled back. The global financial crisis of 2008-2009 was an all-weather test. As liquidity dried up, Berkshire deployed capital on terms calibrated to risk. Public filings and company announcements document transactions such as $5 billion of preferred stock in Goldman Sachs at a 10% dividend with warrants, $3 billion of preferreds in General Electric at 10%, and financing that helped Mars acquire Wrigley, a transaction that later generated substantial profits as noted in Berkshire's letters. These deals required a fortress balance sheet, credibility with counterparties, and rapid decision-making. Not every decision worked out. The 2016 acquisition of Precision Cast Parts, a maker of aerospace components, for roughly $37 billion including debt, was later impaired in 2020 as the aerospace cycle weakened, an outcome disclosed in Berkshire's filings. The Kraft Heinz investment experienced significant write-downs in 2019, as reported by the company. In 2020, during the pandemic, Berkshire exited significant airline holdings, a choice Buffett later called a mistake in hindsight. According to Berkshire's letters and annual meeting Q&A, the response to errors remain consistent: admit quickly, protect the financial fortress, and keep allocating. Meanwhile, leadership depth and succession planning moved from hypothetical to visible. Todd Combs and Ted Weschler joined as investment managers in the 2010s. Ajit Jain and Greg Abel were elevated to vice chairman roles overseeing insurance operations and non-insurance businesses respectively, as reported in Berkshire's disclosures. The goal, stated repeatedly in shareholder communications, was continuity, an institution that endures beyond any single person. What happened next was not a plot twist. It was compounding at scale. The outcome was far from certain in each crisis, but what happened next surprised everyone by its scale, not its logic. The empire can be measured by businesses, capital, and culture. In November 2009, Berkshire announced the acquisition of Burlington Northern Santa Fe, BNSF. The transaction, valued at approximately $44 billion including debt, closed in 2010, according to Berkshire's press release and subsequent filings. It was framed as a long-term bet on the American economy. Railroads move the backbone of commerce, grain, coal, consumer goods, industrial inputs. BNSF provided durable, capital-intensive cash flows suitable for a permanent owner. Berkshire Hathaway Energy, BHE, formerly Mid-American Energy, expanded across regulated utilities, natural gas pipelines, and renewables. According to company reports and public filings, the platform invested tens of billions in generation and transmission, including substantial wind and solar assets. Regulated utilities offer predictable returns on large capital bases, again, a fit for Berkshire's time horizon. Insurance engines, Geico, General Re, National Indemnity, Berkshire Hathaway Reinsurance Group, generated float and underwriting profits across many years, according to annual reports. The operating roster broadened, sees Candies, Dairy Queen, Fruit of the Loom, Lubrizol, Benjamin Moore, Shaw Industries, McLean, Marmon, Clayton Homes, and more. Berkshire's subsidiaries collectively employ hundreds of thousands worldwide. Annual reports have listed workforce figures in the high hundreds of thousands for years. The equity portfolio evolved to include enduring stakes. Coca-Cola and American Express stayed core holdings. Bank of America, entered via a $5 billion preferred investment with warrants in 2011, became a top common stock position after warrants were exercised, as documented in SEC filings. Apple, initiated in 2016 and built up in subsequent years, became Berkshire's single largest equity holding by market value. According to Berkshire's filings and Forbes reporting, Apple's dividends and appreciation added tens of billions of dollars in value. Occidental Petroleum, common shares and warrants initially tied to a 2019 financing, grew into a significant stake. Public records show Berkshire secured regulatory approval to buy up to 50% of Occidental, and in recent years held more than 20%, as reported by the company and financial press. Insurance float scaled. Berkshire reported float exceeding $160 billion in the early 2020s, according to annual reports. Cash and U.S. Treasury bills reached record levels at various points, well over $100 billion, providing ballast and optionality. When Berkshire's own shares traded below intrinsic value, the company repurchased tens of billions of dollars of stock in 2020 to 2022, as disclosed in filings, an owner-friendly, tax-efficient way to deploy capital. Recognition tracked results. According to Forbes 2024 billionaire rankings, Warren Buffett consistently ranks among the wealthiest individuals globally, with a net worth well over $100 billion. Each spring, tens of thousands gather in Omaha for Berkshire's annual meeting, a unique forum where shareholders question leadership for hours. The meeting functions as a masterclass in business judgment. Philanthropy matched the scale of the fortune. In 2006, Buffett announced plans to donate the majority of his Berkshire shares to philanthropic foundations, primarily the Bill and Melinda Gates Foundation and 4 family foundations. According to press releases and Forbes tallies, donations to date total tens of billions of dollars. In 2010, Buffett, along with Bill and Melinda French Gates, launched the Giving Pledge, inviting billionaires to commit at least half their wealth to philanthropy. Hundreds of signatories globally have joined, according to the organization's public records. The compounding engine is visible in both numbers and norms. Berkshire's culture, decentralized autonomy, minimal bureaucracy, simple and aligned incentives, became a managerial model studied by operators and investors. The shareholder letters became widely assigned texts in business programs. The long horizon, rare in public markets, created a quiet edge. But here's what this actually means for anyone watching. The surface is stock picks and big deals. The substance is a repeatable architecture that travels far beyond Wall Street. Several principles explain why Warren Buffett's approach worked, and why it wasn't just luck, timing, or proximity to capital. Start with a sound intellectual framework. Margin of safety, intrinsic value, and circle of competence define what to do and, crucially, what to avoid. According to Berkshire's letters, a rational process beats a charismatic hunch. The framework protects from the seduction of fads. Build or acquire low-cost capital engines. Insurance float, when married to disciplined underwriting, creates investable funds at low or even negative cost over time. Public filings show Berkshire's float rising for decades while underwriting often produced profits. That structural advantage compounds when paired with patience. Prefer wonderful businesses at fair prices. See's Candies and Coca-Cola illustrate the difference between cheap and good. Pricing power, brand strength, and network effects bend outcomes in favor of owners. Paying a reasonable price for high quality often beats paying a low price for mediocrity. Be patient and decisive. Cash is not trash in this framework. It is stored optionality. Berkshire's preference for holding cash and U.S. Treasuries when opportunity is scarce is documented in filings. Conversely, preferreds and warrants during the 2008-2009 crisis showed decisiveness when risk-reward tilts sharply. Delegate to great managers and get out of their way. Berkshire's subsidiaries operate with autonomy. Headquarters is small. Incentives are aligned. According to years of letters, This simplicity is a feature, not a bug, allowing entrepreneurial energy to remain where the work is done. Avoid permanent loss of capital. Mistakes happen. The system reduces the odds of ruin. Conservative financing at the parent, resilient cash flows from diversified operations, and an aversion to short-term leverage allow survival through cycles and optionality after shocks. Communicate with clarity. The shareholder letters operate as an owner's manual. They set expectations, define terms, and teach principles. This communication attracts like-minded partners, shareholders, managers, and employees, who reinforce the culture instead of fighting it. Anchor in something larger. The philanthropic commitments recast wealth as a tool. According to public statements and donation records, giving is part of the plan, not an afterthought. That perspective shapes internal decisions and the kind of partners who engage with Berkshire. Why it wasn't just luck or privilege emerges in repetition over 6 decades. Discipline when exuberance dominates, action when fear paralyzes, and relentless focus on durable economics over optics. The behaviors compound. What's required to adapt this playbook at any scale is accessible. Define a circle of competence, preference for quality cash flows, conservative balance sheets, patience, and willingness to act when odds favor. Not everyone can buy railroads or insurers. But everyone can borrow the spine of the system: quality over quantity, time over timing, alignment over theatrics, and compounding over churn. Modern applicability is strong. In faster markets, patience is scarcer and thus more valuable. Software and platforms alter moats, but moats still matter. Subscription models and prepayments, modern cousins of float, create similar allocation opportunities when handled responsibly. The American tailwind, Buffett's phrase in letters, remains relevant. Productive assets, held over time, under discipline, tend to reward owners. But that's not the full picture. Behind the headlines is a pattern, hiding in plain sight, used by empire builders across eras to multiply wealth systematically. It's what most people miss about how Warren Buffett did this. The Forbes 400 know it. They exploit it. They've built fortunes with it. It breaks down into 4 proven deployment methods that multiplies wealth systematically. First link in the description. Watch it next. 10 minutes that could change everything.